Well, let's get a special conversation going now. The managements of Radiant Life and Max India held a conference call earlier this morning to discuss details of the merger of Radiant and Max's hospital business. Joining us now is Abhay Soy, Chairman and MD of Radiant Life. Good afternoon, Abhay. Thanks so much for speaking with us. Now, we have discussed the basic details of the merger earlier, but there have been some concerns on the valuations, whether they're actually a little more skewed in favor of Radiant. Can you help us understand how you arrived at that valuation figure of 7,000 crore rupees?
So, over 7,000 crore is essentially a combined value which has been estimated, and the valuation of Radiant is a combination of factors. It's the combination of the valuation at which KKR came in to Radiant. So that's at a valuation of 2,883 crores, and other than that there has been a formula which has been applied by the independent valuers of the two companies, which is E&Y and KPMG as well, whereas valuation has been done on the basis of multiples as well as GCF.
Okay, fair enough. Now, Abhay, what is the consolidated debt on the books of the entity, and what is the plan with respect to this debt going ahead?
So there are two things. I think the consolidated debt on the books of the entity is going to be about 2,200 crores. And as far as the plans for the debt is concerned, obviously we are looking to ramp up the EBITDA margins of the combined entity as well in order to support that debt. So I think, in due course we should be, in the short to medium term itself, we should be fairly comfortable with in terms of the debt and the debt coverage.
Okay, can you give us some sort of an outlook on consolidated margins? I mean, where do they stand right now, and where should we expect them to be once this whole merger is through?
So at present, our Delhi NCR business is operating at about 16% EBITDA margin. It's a young business. It was a hospital which has been commissioned in 2010. So at a 60% capacity utilization, we are operating at about a 16% EBITDA margin post our corporate overheads and all. As far as Max is concerned, it's in the public space what their present EBITDA margins are. How we are going to be operating at a higher EBITDA margin and in what time frame, for that we'll have to dig in a little deeper, because so far, it being a listed company, there has been, the access to information, at least the operating level metrics, etc., has been limited. But going forward, that's what we are looking to track at.
Okay. Now, initially, the promoter holding, as we understand, is going to be about 82%, and then that will have to, of course, come down to 75% to comply with regulations. Can you tell us how that's going to happen? Are you already in talks with potential buyers?
So post the merger, post the listing of the company, we need to have a minimum float of about 25% with the public. Like you rightly pointed out, 82% will be there between myself, KKR, and including the 7% which will be with the promoters of Max India Limited. And between the three of us, there is an inter se understanding that we will be in ratio, in proportion of a shareholding, we will be selling down 7% of the holding. So it's not necessarily dilutive to the shareholders. Essentially, we will be using KKR's reach to reach institutional shareholders and perhaps do block placements at that point in time.
Okay, fair enough. So, when can we expect the sell down to actually take place? Do you have some timelines in mind that you can share?
So this sell down will have to be post listing itself. So post the merger, post listing, which will be about 8 to 12 months, given all the regulatory clearances that we require. It will be done subsequent to that.
Let's talk about capex and future plans then. Do you have a figure in mind? Are you looking at brownfield or greenfield expansion? How many more beds do you want to add? And then, of course, funding for the same.
So there is significant amount of capex brownfield capex within the two entities, whereas in the case of Max Smart is something which is going to be expanded significantly by putting up another 600 to 700 beds over there. We are looking at expanding the capacity of Nanavati in Bombay, by about another 500 to 550 beds, and Delhi BLK by 200 beds. Now, essentially, what this gives us is a very unique positioning in perhaps the two best micro markets, metros in India, and micro markets within those metros. That is South Delhi as well as Juhu in Mumbai. The lands are already available with us. The land banks are there. So it will essentially be a brownfield expansion, unlike a greenfield expansion, which is done at significantly lower cost, because brownfield don't usually have operating losses at startup, because it's basically increasing the capacity in a phased manner. So we are looking forward to this capex. Now, both this capex is going to be done over the period of the next 4 to 5 years. We believe it can be done through a judicious mix of internal accruals itself, other than whatever leverage we require to raise to support this expansion. But really, we are creating those assets in Delhi and Bombay.
Okay, fair enough. What are the kind of operational synergies we can expect, and by when do you think some of this will start flowing through?
So I think there are plenty of operational synergies that one can look forward to, and especially in the NCR region, with whether it's respect to the clinical programs, the reach our doctors have, and so on and so forth. Other than that, if I look at from a marketing standpoint, the international marketing piece at BLK, 25 to 30% of our revenues come through international marketing. And given the fact that we are, our enterprises are based primarily in metros, it would help us in the international marketing and so on. So that's one part. Attracting doctors, having focused clinical programs, having, anchoring certain hospitals with stronger specialities of a certain nature, whereas others can have complementary skills and so on. So I think whether it's the top line or whether it is the bottom line, at present, if you look at the Max network, as far as variable cost management is concerned, they do it far better than Radiant. They have a 200 to 300 basis points advantage over there. But whereas the fixed cost management is concerned, Radiant does it in a manner which is exponentially better than Max, so which is another 300 to 400 basis points over there. So putting this together should be able to give us significant amount of synergies going forward. Again, the approach, the investment in technology, the allocation of technologies within metros is more similar to tier 2, tier 3 cities. So, there are a lot of operational synergies between the two enterprises.
Okay, Abhay, we'll leave it on that note for today. Thanks very much, and thank you for giving us details of the business plan as you see it going forward. Let's move on now and talk about some news that's coming in for the IT space. And it's actually quite good news. This is a cnbc TV 18 exclusive. In what can be a big boost for the Indian IT sector, IT outsourcing contracts worth over $43 billion are coming up for renewal. That is as per data exclusively sourced by us from the Everest Group. Kritika has all the details on this one. 43 billion, that's a big number, Kritika.
That's huge. And if you look at the kind of deals that come in for Indian IT, I think last year the deal renewal was around 12.3 to $12.4 billion roughly. So new IT deals typically are rare. So when you have a renewal deal specifically for traditional services, that can lead to a lot of amount coming in. So let me just break this out. This is data that we have been able to source from Everest Group. And here's the breakup. Deals worth $43.4 billion will be coming in FY20. So starting April onwards, we are likely to see these deals come in. Some of these are already at a point of negotiation and some bidding is likely to begin soon. If you break this up, we understand that government sector is a significant portion. So that's 50%. BFSI is 20%. Tech and communication is 10%, and remaining are from allied services. The top three countries that are contributing here are largely USA 38%, UK 25%, and India is interestingly 8%. And typically we don't see India featuring in the top three. So that is quite significant, Surbhi. So that's largely as far as the broad framework for what the deal pipeline is going to be.
Okay, well, that's on the IT contracts. The other thing is there any sort of specification about the renewals and who could be perhaps getting some of these big ones?
So, it's really wide, but we've been able to narrow down on which contracts are going to be significant. So, let me start one by one. The largest is coming from Zurich Insurance Group. That's about $4 billion. This is for infra services, app development and maintenance. Bharti Airtel, interestingly, has $2 billion worth of contract that are likely to come up for renewal. So, that's for app development, maintenance and infrastructure. Again, these areas are very traditional IT deals. They're not the digital services. So, in terms of value, they are much larger, clearly. Saudi Telecom has deals worth $2 billion for BPO services. Sanofi, for a $1 billion deal, they are looking for BPO services across the board. So, that's coming up for renewal. Resolution Life Group, which is a US and UK life insurance major, that's about to renew a $1 billion BPO services contract. And Swiss Re, which is a $500 million, that's about for BPO and insurance platform. So, interestingly, a lot of the large deals that we've been able to source out is insurance, and the others are within the telecom and the technology space. We try to understand if the IT players will be bidding. We spoke to TCS, Infosys, HCL Tech, Wipro, Cogni. All said, of course, off record, that there is a possibility that they would like to bid, but it has to first come up for renewal.
Seem to be ending the first week of 2019 on a positive note for more than one commodities. Look at the crude oil prices, and we are up 3% for the US crude, 6% up for the Brent crude as well. And this is after very, very volatile every day of this week. The other sector which really seems to be closing as a superstar really is the precious metal space. We have seen good amount of buying coming for gold, which is trading at a 7-month highs in the US dollar terms, at record highs in Australian dollar, at 3-year highs on Canadian dollar, and we are trading quite at a multi-week highs in the Indian markets as well. The support clearly comes in from the weakness in US dollar, the partial shutdown in the US government, and of course we also have seen safe haven buying as we saw the equity markets around the world go for a tumble. Today, of course, seems like a better day for all asset classes, but precious metal prices clearly playing to that tune. Georgette Boyle is Global Head Forex and Commodities, and she joins us on a phone line to talk further about that. Georgette, hi, good to have you. Happy New Year to you. What is your sense, the way we have opened this year for the precious metal prices? Do you see this continuing, really?
Happy New Year to you too. Yes, on the precious metal side, we had a very good start to the year, especially if you look since the low set in August last year. Gold prices have been up like almost 10%, and palladium even 40%. And yeah, we expect more to come this year. In near term, though, there could be some consolidation or some profit taking as. Yeah, we had already such a good run, but especially for the end of the year, we see 1400 versus the US dollar. The main reasons for that is that we expect a much lower dollar across the board, so also versus main currencies and emerging market currencies. We also expect some recovery of the Chinese yuan, and that has also to do with that we think that sentiments towards China will become a bit more constructive, and therefore expectations about demand from China will also improve. So we also expect some pickup in jewelry demand, which should support both gold and platinum, but also silver. And yeah, the fact that we don't expect much more rate hikes from the Fed. We only have one other for this year, should also have some support for gold prices. In terms of on the technical side, we are above the 200-day moving average, which is now around 1250. And that also changed the picture towards much more positive. And you see as well that investors are jumping a bit on the bandwagon. A few weeks ago, some of the positioning was neutral or even negative in the case for silver, and you see now they have been started buying, but net longs are still relatively small, so there is much more room in there. 1300 is the first psychological level. We have come close this morning, and it looks like some profit taking ahead of the non-farm payrolls.
Sure.
The next level after that, the big one is 1366, which has been the highs of last year.
Georgette, if, as you said earlier, there is an expectation that we might also see $1,400 per ounce on the higher side as well. Any timeline that you see for that? And with that kind of gain in gold, do you see silver also surging around?
Yeah, we have that for the end of next year, or for the end of this year, 1,400, and for the end of next year, even 1,500. And yes, we also expect a sharp recovery in silver prices. We think they have been beaten up too much. It's the more volatile precious metals compared to gold. But in an environment that gold prices would rally, silver prices would do also very well. And we have for the year-end target 18 for silver, and for the end of 2020 we have even 20. So we expect higher prices on gold, silver, platinum. We are not that optimistic on palladium. We think that most of the positive news is in the price, and we think that palladium is a bit overrated in the current environment.
All right, Georgette, thank you so much for joining us. So that's quite a bullish view coming in from ABN AMRO. As Georgette says, that the gold prices, once they clear 1,300 on the higher side, can hit 1,366, even 1,400 before we end this current year. Sumit Bagaria as well now joins us with his sense on all of that space. Sumit, hi. What is your sense in the Indian markets then? If we are not expecting the US dollar to continue to strengthen, that would mean a stronger rupee going forward at least. In the Indian markets, what kind of gold prices can we see?
Hi, good afternoon, Manisha. Well, see, in last couple of days, we have seen a very smart move in gold from low levels. From the levels of 1220, 1240, we have seen a one-way move till $1,290 in COMEX. I think immediately a psychological resistance will, psychological resistance of 1,300 is there. So I think till the time the levels of 1,300 are not taken away in COMEX, we can see some profit booking or some correction in gold from present levels that can take prices to $1,270. So purely for a trading perspective for next couple of days, it's better to be on sell side in gold. From 31,700, 31,800 levels, one can initiate sell positions with a strict stop loss to be placed at 31,900 levels on lower side for the downside target of 31,300 levels. This would be a very immediate, this would be a call for next 2 to 3 days purely for a trading perspective. Overall, we feel that sooner or later gold will break $1,300 on COMEX, and from there we will see a move till $1,320 or $1,330. So any such correction in MCX till 31,300, 31,400 level should be used as buying opportunity for medium to long term time horizon. Purely for a trading perspective for next 3 to 4 days, one can initiate sell positions at CMP.
What's your sense also on the steel, or rather the metal prices? Because we've seen a run-up in the metal prices finally on the last day of this week. And this is after China has cut bank's reserve ratio. We also have seen China actually introduce $33 billion for railways, for the infrastructure as well. So there are those measures. The stimulus is finally coming in from China. How much of a support do you see them giving to the metals?
See, most of the metals have given a good correction in last couple of days. Immediately, we feel that metal should find some support at present levels, and from here on we should see some bounce back or some pullback in most of the metals like zinc, aluminium, nickel. At present, for a trading perspective, zinc looks best commodity to trade in. It's presently quoting at around 172 levels, 172.50 levels. I think one can initiate long positions at the current market price, or if there is a dip of around 1 to 1.5 rupees from present levels, then that should be used as a buying opportunity with a strict stop loss to be placed at 168 levels on lower side. And on higher side, we can see zinc to touch levels of around 175, 176 in next couple of days. If the levels of 175, 176 are taken away, then there is a possibility that we might see a good up move till 180 levels. So 175, 176 would be the resistance. One can initiate long positions at current market price for the targets of 176 levels.
All right, so buying calls coming in for the metal space, whether it's precious metals or the base metals, courtesy what China really has done in sense of measures there. Thank you so much, Sumit, for joining us today and giving us those strategies. And with that, that's all the time that we have on Closing Bell. Thank you for watching.